The end of this year and lean into 2023 will potentially set up a once-in-a-lifetime opportunity to generate wealth, and watch this video will enable you to know what 99% of people don't, and that's how to invest during a recession. But what is a recession, or rather what are the steps to take forth that let us know that we're heading into one, and how do we come out thriving rather than just surviving? And of course, before the video starts, it's not financial advice. A recession is generally caused by a bunch of money being pumped into the economy, and then everyone is buying all these goods and services all at one time, all the money is flowing, but all of a sudden we see a switch where inflation goes rampant, we see the interest rate heights, we see cost of living go up, food, petrol, all these prices soar, and then people can't afford anything all of a sudden, so they hold their money. So at this point the market contracts and people start avoiding these lavish items and instead focus on the most important things that are essential for life, such as petrol to get to and from work, the food, water bills, energy costs, all the basic stuff, and then they save the rest. Now, if that doesn't scream 2008 repeating, I don't know what does. In fact, Graham Stephan recently tweeted about a bunch of headlines indicating numerous economic factors reaching certain points not seen since 2008, which should instill fear into all of us. Executives are already saying we're in a full recession or will be soon. So what can someone with hypothetically no money do right now? The basics start by buying the essentials and skipping a bit of extra cash from your job and just save it in order to invest later in time, but we'll talk about that later. It's not spending money on groceries that's the problem, it's instead buying nails, clothes, and all the other stuff that you don't need. As it just dries up all your savings, so just focus on the important things and build an emergency fund in case of job loss. Now that we have all the basics out of the way, which aren't that complicated, instead let's look at some general market sentiment. The average bear market for the S&P 500 falls nearly 30% while lasting 9.5 months. However, if we combine both a recession and a bear market, this worsens to an average of 34.8%, which obviously is a drastic decline. And for reference, we're currently down 20%, so we likely have a lot further to go. Actually, my favorite analogy for recessions is the t-shirt theory that I created myself. And it's, if you have a $100 t-shirt and at the start of the year and it drops 20% like we are right now, so you buy it $100, it's a cool t-shirt, same as a company, $100, you like it drops to $80, that falls at 20%, and you still like it, still the same shirt, same company, then why not buy more? Market sentiment, the way people, the general person thinks is, oh no, my shirt's fallen $20, I need to sell the shirt. Instead, let's go like, oh, dropped $20, I like the shirt. Oh, it's dropped that 34.8%, so to $65. Wait, this is a really cheap shirt, and it's the exact same shirt. Let's buy more of them. This is the market sentiment we need to think about. So whilst the average person will be fearful and sell everything because the market's dropped 30%, really perspicacious investors will be like, oh, I got my stock at a discount, same as a t-shirt, let's buy more and more and more and take advantage of this opportunity. What's crazy is after stocks reach a trough, so the bottom of the market, that exact point, exactly 1 year later, its stock goes up 40%, and then 2 years later from the trough, it's 54%. So the market rebounds very, very rapidly and quickly in a sharp upturn. So with that market analysis, hopefully it gets a clearer picture of what to expect. Now to stay grounded in a recession, the safest assets are ones that generate high cash flow. With real estate, yes, the price of the home fluctuates, but at the same time, the cash flow from rent doesn't change one bit. It stays the same from point A to point B. Should interest rates continue to go up, which they likely will because of inflation, expect property to drop over the next 12 to 18 months as a lagging indicator of the market. But ultimately, over the next couple of years, we will see more room for negotiation on deals and less competition from other buyers as there's less demand in the market. To conclude though, if you're looking for long-term deals, keep looking for them and they'll come. Another option are high dividend yield stocks, and since the market's in a massive downturn, they're much cheaper and still have at least a 3% dividend yield usually. Look at BHP for instance, it has a dividend yield of 12% and since April has fallen 30% from its highs and now sits at just $37.48 at the time of recording. So a dividend portfolio is a perfectly logical approach to investing because if you're scared of the high fluctuations of high growth stocks and you're worried about sharp downturns, then you won't have to worry about these stocks because they don't fall too rapidly. Now, with growth stocks and the tech sector in particular, they're down bad. In fact, 7 of the top tech stocks have lost over $3 trillion between them just in the last year. Meta has been in freefall, reaching price levels we haven't seen since 2016. Amazon treads amongst the same prices during the downfall of 2020, and Netflix the same share price as parts of 2018. But this isn't necessarily because revenues are falling, it's in fact the forward guidance that we're worried about. They expect income to fall and costs to skyrocket as we worry about the Nasdaq and the whole market in general falling rapidly in the next year. This is because tech witnesses firsthand the economy's sentiment through data sources like Google Trends, and then the other companies tend to follow suit. However, with large downfalls across the board, there's plenty of opportunity out there to buy some high growth stocks for the next few years to come. provided you've done the research yourself and can come to a logical conclusion about each individual company. But if not, always continue to dollar cost average in the S&P 500 as it returns the market anyway and beats 89% of fund managers in the process, so that's your safest option for investing. Ultimately, the best way to make money in a recession is to keep your job. With the majority of large companies introducing layoffs, it is important as ever to make sure you keep your primary source of income, because obviously there's no use worrying about investing if you can't earn money. The worst case scenario in a recession is you lose your job and have to sell off your investments at the bottom of the market before they have time to recover again. And as always, I highly recommend developing a stronger skill set and also looking at other ways to make some cash along the way outside of your job. If this video helped you, it may help someone else, so don't forget to share the video, subscribe, because I'm trying to educate as many people as possible on the things that don't teach you in school. Thanks for watching and heading out.